Welcome to the Opening Bell Report.
I have to be honest with you right out of the gate here. When I saw the subject of this analysis report, I actually, checked the date to make sure I wasn't reading something from 20 years ago.
Yeah, I get that.
Because usually when we sit down to talk about the absolute bleeding edge of tech AI, neural networks, all of that, we're talking NVIDIA or OpenAI or, some scrappy startup.
That is the standard roster, yes.
But the report we are looking at today is screaming at us to look at Oracle. And I mean, come on.
Oracle.
Oracle, the database company. It feels like we're talking about a museum piece.
Yeah.
When I think of Oracle, I picture like beige cubicles and expensive licensing audits.
The software your dad's company used.
Exactly. Back in 1999. I do not think high-growth AI innovator.
That reaction is exactly why this opportunity exists. That perception that Oracle is just a slow-moving legacy dinosaur. That is the consensus view. But the analysis report we have in front of us argues that while everyone was distracted by ChatGPT and NVIDIA's stock, Oracle has pulled off what might be the most significant under-the-radar pivot in modern tech.
A pivot to what? Because last I checked, they were still selling databases.
They are. But the core thesis of this report, the Oracle Moonshot, as they call it, is that Oracle has effectively transformed itself into a critical AI infrastructure arms dealer.
An arms dealer.
They're not just a software company anymore. They are making a massive leveraged play to become the physical backbone of artificial intelligence.
Arms dealer implies they're selling the weapons everyone needs. But aren't Amazon, AWS, and Microsoft Azure already doing that? I mean, they own the cloud. Why does anyone need Oracle?
That is the trillion-dollar question. And the answer, according to this analysis, lies in a rumor that's setting Wall Street on fire. We are talking about a capital raise plan for 2026, that is.
Well, it's staggering.
That's staggering.
$50 billion.
$50 billion with a B.
50 billion. Okay, just to be clear, companies don't raise $50 billion unless they're planning to buy a small country or what?
Exactly. You don't raise $50 billion to just tweak a database. You raise that kind of money to reshape the physical internet.
Wow.
So our mission today is to figure out if this is real. We need to understand how a legacy player became a hardware contender, why the stock just smashed through a huge resistance level, and whether this $50 billion bet is a masterstroke or a gamble that could sink the ship.
Okay, I'm listening.
Yeah.
But I'm still skeptical.
Oh.
Let's start with the market context. The report leads with something called the infinite demand problem.
Mm-hmm.
I thought the problem was we didn't have enough chips.
That was last year's problem. The chip supply is actually loosening up. The bottleneck has moved.
Moved to where?
The report describes a situation where the big two, Microsoft Azure and Amazon AWS, are effectively tapped out.
Tapped out how? They have data centers everywhere. I could spin up an AWS server right now.
You can spin up a server to host a website, sure. But AI is a completely different beast. It requires massive power density, specific liquid cooling. Things old data centers just don't have. The report highlights that AWS and Azure are capacity constrained for high-end AI compute. They are physically unable to meet the demand. Their infrastructure was built for the internet of 2010, not the AI of 2026.
So it's like trying to plug a Tesla supercharger into a standard wall outlet. The wiring just can't take it.
Precisely. That's a perfect analogy. They are scrambling to retrofit their old sites, literally trying to upgrade existing buildings while they are still running. It's slow, it's expensive.
And it creates a waitlist.
A massive waitlist. And this is where Oracle stepped in.
Because they didn't have as many old data centers to worry about.
In a way, yes. Their weakness, having a smaller cloud footprint, became a strength. They looked at the market a few years ago and said, we aren't going to build general-purpose cloud. We are going to build fresh, purpose-built AI infrastructure from the ground up.
And the client list mentioned here is pretty interesting. It's not just banks. We're talking OpenAI, XAI,
Elon Musk's company,
and even NVIDIA themselves.
That NVIDIA contract is the smoking gun. Think about it.
Okay.
NVIDIA makes the chips. They know exactly what those chips need to run at peak performance. When NVIDIA chooses Oracle Cloud to run their own internal stuff, that is a stamp of technical approval that goes way beyond you had availability.
But I have to push back here. Is this just an overflow parking lot situation?
A fair question.
If I'm OpenAI and Amazon is full, I go to Oracle because I have to, not because I want to. That doesn't sound like a long-term advantage. Once Amazon builds more data centers, don't those customers just go back?
That is the bear case, and it's a valid fear. If Oracle is just the backup plan, the stock is overpriced.
Right.
But the secret weapons section of this analysis argues that Oracle has actually built a better mousetrap. It comes down to architecture specifically, a technology called RDMA.
I saw that acronym, RDMA networking. It sounds incredibly dry. Why does a specific type of cable or protocol matter so much?
Because for AI training, latency is the enemy. When you train a massive model like GPT-4, you aren't using one computer. You are using a supercluster of maybe 10,000 GPUs all working together.
So they need to talk to each other fast.
Extremely fast. In a traditional cloud setup like the standard Ethernet that AWS was built on, when GPU A wants to talk to GPU B, the data has to travel up through the server's operating system, go through the network, hit the other server's OS.
That sounds like a lot of stops.
It is. It's like passing a note in class, but you have to hand it to the teacher who reads it, stamps it, walks it over. It creates delays, latency.
Yeah, and RDMA fixes this.
RDMA stands for Remote Direct Memory Access. It allows one GPU to reach directly into the memory of another GPU on a different server.
Without checking with the OS.
Without checking with the OS or the CPU at all.
So it's like telepathy.
Effectively, yes. It bypasses all that bureaucracy. The report states that Oracle's implementation of this, their RDMA superclusters, allows them to train models significantly faster and cheaper than Azure or AWS.
So if I'm spending $100 million on a training run, and Oracle can finish it 20% faster.
You just saved $20 million and got your product to market weeks earlier.
So that's why the contracts aren't just temporary overflow.
Exactly. Oracle has positioned itself as the premium tier for training. They don't need to beat Amazon at hosting Netflix. They just need to beat them at high-performance computing.
That makes sense. Speed is money. But there's another piece of this moat the report talks about, and it's egress pricing. This feels like a direct shot at Amazon.
Oh, it is an aggressive shot. The Amazon and Microsoft model is often compared to the Hotel California. It's easy and free to put your data in their cloud.
But not to get it out.
But if you want to take it out, to move it anywhere else, they charge you massive fees. It's a lock-in tax.
I've heard startups complain about this. They get the bill for moving their own data and their eyes pop out.
Exactly. Oracle saw that frustration and just slashed those fees. For a startup or an AI company that needs flexibility, that is a massive financial incentive.
It signals they're willing to play nice.
In a multi-cloud world, yes. Whereas Amazon wants to own you completely.
And of course, we can't ignore the legacy part. The report calls it legacy lock-in, but frames it as a positive.
That's the anchor. We made fun of the databases earlier, but most of the Fortune 500 still runs their core business on Oracle. That data has gravity.
It's heavy and hard to move.
Very. So if Oracle says, hey, your data is already sitting here, why don't you bring your AI models to the data instead of trying to move petabytes over to Amazon? That is a very compelling pitch to a CIO.
Okay, so they have the tech advantage in the customer base. But let's look at the financials. Stories are great, but we need to see the receipts. The report flags a metric called RPO.
RPO, remaining performance obligations.
Okay, that sounds like accounting jargon designed to put me to sleep. Why does this matter more than just revenue?
Because revenue looks backward. It tells you what you billed yesterday. RPO tells you what you are contractually guaranteed to bill tomorrow. It is the backlog.
So it's future visibility, money that is effectively already won.
Precisely. And Oracle's RPO has absolutely exploded. The report highlights that it has swelled to over $80 billion.
$80 billion. That's not a small number.
And if you look at the broader backlog figure they cite, which includes longer-term commitments, we are seeing numbers upwards of $523 billion.
$500 billion. That's the GDP of a mid-sized country.
It is staggering. But the key is the growth rate. This backlog is growing over 50% year over year. That is way faster than their current revenue growth.
Which tells you demand is accelerating.
They are signing contracts faster than they can fulfill them.
Which brings us back to that moonshot moment. If they have all this signed business, why do they need to raise another $50 billion?
Because they have a good problem. They don't have the factories to build the products.
And the data center is the factory.
Exactly. And unlike software, data centers require steel, concrete, copper, and massive power plants.
So Larry Ellison is looking at that $80 billion backlog and realizing he physically cannot fulfill it with his current buildings.
That is the all-in move. He is betting the farm. This potential $50 billion raise is for a capital expenditure blitz. He's going to build massive gigawatt-scale data centers to unlock that backlog.
This is the part that makes conservative investors sweat, though. $50 billion in new debt when interest rates aren't zero anymore. Isn't that dangerous?
It is polarizing. The dividend investors, the ones who liked Oracle for its stability, they hate this.
They see risk.
They see interest payments eating into profits. But the growth investors, they see it as a signal of supreme confidence.
It's putting your money where your mouth is.
It's Larry Ellison saying, I see the future so clearly, and I trust these contracts so much that I am willing to leverage the entire company to build it. If he's right, Oracle becomes the ExxonMobil of the 21st century.
The infrastructure provider for intelligence.
That's it.
And looking at the charts, the market seems to be siding with him.
The technicals are screaming bullish, The stock had been stuck under a ceiling at 150 for a long time. It recently smashed through that and traded up to 156.
The report mentions a pattern called gap and go. Can you explain that for the listener who isn't a day trader?
Sure. A gap is when a stock opens way higher than it closed the day before, leaving a blank space on the chart. Usually gaps get filled, meaning the price drops back down.
But a gap and go doesn't.
It doesn't look back. It popped and kept running.
What drives that? Is that just retail traders getting excited?
No, that is usually institutional panic buying.
Panic, but you mean the big hedge funds?
Yes. A lot of funds were underweight on Oracle because they saw it as a slow growth stock. Suddenly, the narrative changes, the price breaks out, and these fund managers realize they're missing exposure. They have to buy in, regardless of price.
So what's the ceiling here? If we're at 156, where does the analysis see this going?
The base case is 185. That's based on a valuation of roughly 25 times their expected earnings in 2027.
And the moonshot case. If the market decides Oracle is cool again.
If the market re-rates Oracle to be an AI prime stock trading at higher multiples, the target moves to 220, that's significant upside from here.
But, and you knew there was a but coming, we have to look at the downside. The report calls it a gravity check. What happens if this goes wrong?
Because you can't just hit undo on a gigawatt power plant.
Right.
The biggest risk is the debt load combined with a potential AI winter. If AI demand cools off in 2027, if the models stop getting better, or companies stop seeing ROI, Oracle is in big trouble.
They'd be left with expensive empty buildings and huge interest payments.
And unlike software engineers who you can lay off, you cannot fire a half-built data center. The capital is sunk. If the revenue stops, the debt could crush them.
What about the execution risk? The report mentions logistical nightmares.
It's non-trivial. They want to build, say, 100 new data centers. Do you know how hard it is to get power permits for one of those right now?
I can imagine.
You are fighting with local governments, environmental regulations, utilities. The grid is constrained.
So they could raise the $50 billion and just sit on it because they can't get the permits.
Or face massive delays. If they can't build fast enough, they breach those contracts. Clients like OpenAI won't wait forever.
And margins. Construction is expensive.
That is the other warning flag. Investors are used to Oracle having juicy 90% software margins. Hardware is a dirty, low-margin business.
Building concrete bunkers doesn't scale like code.
Not at all. The report warns that we might see their profitability dip in the short term while they spend this money.
So if you're buying in, you need to be prepared for the earnings reports to look a little messy for a while.
Exactly. This is a construction phase. You have to have the stomach for the dip before the payoff.
Okay, so let's wrap this with a verdict. The report rates it a BUY aggressive.
They do. They're saying the old Oracle is dead. Stop analyzing it like a database company. The new Oracle is a pure play infrastructure bet.
Picks and shovels.
The ultimate picks and shovels. They aren't trying to find the gold, the perfect AI model. They are leasing the heavy machinery to all the miners.
And selling shovels is the safest way to play a gold rush.
Historically, yes.
For the listener who wants to take action, the report suggests some specific entry points. They say don't chase the spike.
Right. FOMO is your enemy here. The stock just popped. The prudent move is to wait for a pullback. Look for the price to come down and test that breakout level around 150 to 152.
That's the buy zone.
That's where you want to enter. And to protect yourself, set a stop loss below 142. If it drops below that, the breakout has failed and you want out.
Smart risk management. You know, this whole deep dive has really shifted my perspective. I came in thinking about legacy code, and we're leaving talking about industrial construction and the backbone of the internet.
It is a return to the physical world.
It really is. And that's the thought I want to leave our listener with. We've spent the last 20 years watching software eat the world.
The era of the asset-light business.
Exactly. But now, to keep the AI dream alive, a software company is planning to spend $50 billion on concrete, steel, and power plants.
It feels like the cycle is closing. We're remembering that the cloud is actually just a building full of hot metal.
It does. It makes you wonder, is this the ultimate validation that AI is the fourth industrial revolution, requiring real industrial infrastructure? Or is the fact that we have to spend this insane amount of money just to keep the models running a sign that we're reaching a peak?
That is the $50 billion question.
It certainly is. We'll be watching closely.
Don't forget to like, share, and subscribe for more.